All right, welcome. Today we are diving deep into what I like to call the market's cheat codes. We're talking about the lead indicators that let you see where institutional money is being forced to move before it actually happens. So let's get right into it.
So let me ask you this. Do you ever feel like you've got the perfect setup, you jump into a trade, and then bam, the market just rips in the opposite direction and takes you out? It's that classic, super frustrating feeling of always being one step behind the big players.
Well, what if you could flip the script on that? What if, instead of reacting to price, you could start anticipating it? The key, really, is to look past what the price is doing right now and start reading the underlying forces that are compelling market makers to act. We're talking about leading indicators here, not the lagging ones everyone else is watching.
Okay, so our first key metric is skew. The easiest way to think about this is as the market's fear gauge. It's an incredible tool because it tells us what the smart money is really thinking, no matter what the price chart might be showing you.
So what is it exactly? Well, skew simply measures the difference in implied volatility, the expected price movement, between put options and call options. Now, in a normal, healthy market, puts are usually a little more expensive. Why? Because big institutions are constantly buying them as portfolio insurance, just in case things go south. Skew tells us when that demand for insurance gets totally stretched to an extreme.
So how do we actually interpret this? It's pretty straightforward. When you see the skew ratio on the Market Vision dashboard climb above 1.20, that's a huge bearish signal. It means institutions are paying a massive premium for downside protection. That is pure fear. On the flip side, when that ratio drops way down, below 0.85, it's a totally different story. That means calls are getting pricey, which is a classic sign of greed, of FOMO kicking into high gear.
And this brings us to a killer setup we call the ceiling trap. So picture this. The price is rallying hard, pushing right up against a major resistance level, what we call a call wall, which is just a price level with a giant pile of call options. Now on the surface, everything looks bullish, but if you look at your skew and see it creeping above 1.20, that's your signal. That's the tell. It means that even as the price is rising, the smart money is quietly buying up expensive insurance. Fear is building right under the surface, creating an absolutely fantastic, high-probability setup for a short trade.
All right, let's move on to our next metric, because this is where it starts to get really interesting. Let's talk about charm. I like to call this the clock drift, because it's this predictable force that pushes the market around based on literally nothing more than the passage of time.
The logic here is actually really simple, but it's incredibly powerful. You see, market makers, the folks on the other side of all our trades, have to stay delta neutral. All that means is they try to balance their books so they aren't making a bet on which way the market is headed. But as time passes and options decay, their positions get all out of whack. Charm measures this time decay, which literally forces them to either buy or sell the underlying stock just to get back to neutral. It's a forced action, and we can track it.
So the takeaway here is super important. Positive charm creates a buying drift. The clock is literally forcing dealers to buy stock, creating a natural tailwind for the market. And you guessed it, negative charm does the exact opposite. It creates a selling drift, a headwind, as those same dealers are forced to sell.
So here's how you use it. Let's talk about a setup called the afternoon ramp. Okay? Imagine it's after 2 p.m. Eastern, late in the day, and you see a really strong positive charm reading. Bingo! You've got a tailwind for any long positions. Even if there's no news, no big catalyst, dealers are being systematically forced to buy shares into the close, which can seriously amplify any little upward move.
Okay, so we've got skew measuring fear, and we have charm measuring this time-based pressure. Now for the really fun part. Let's combine them and build the actual blueprint for spotting those institutional-grade A+ setups.
This is really where all the pieces of the puzzle come together. By layering skew and charm, we're not just looking at a couple of separate signals anymore, we're building a complete, high-conviction trading plan. So just take a look at this blueprint. For a true grade A institutional long, you're looking for the perfect storm of three things. First, price is hanging out near a major support level, like the put wall. Second, you see skew dropping off from a peak, which tells you fear is starting to fade. And third, you have that positive charm creating the buying drift we talked about. For a short, it's just the mirror image. Price is near the call wall, skew is rising as fear builds, and negative charm is adding that extra selling pressure. And I really want you to remember this. When these conditions all line up perfectly, you are no longer just guessing at a support or resistance level. You're not just hoping for a bounce.
You are actively trading with the forced hand of institutional players. That is a massive, massive edge.
But what if we could add one more layer to this? You know, like an accelerant that tells us just how much fuel is behind a potential move. Well, let's talk about Vanna.
Vanna is our gasoline meter. In simple terms, it measures how dealer positions are affected when volatility itself changes. Basically, it tells you if a rally has the fuel it needs to keep going, or if a sell-off has enough gasoline to turn into an absolute fire. Is the move for real, or is it running on empty?
On the dashboard, we visualize this as the gas meter, and it's super simple. A green bar means Vanna is highly positive. That's bullish fuel. A red bar means Vanna is deeply negative, and that signals intense bearish pressure, a situation where any little spike in fear could trigger a huge wave of forced selling.
So here's the bottom line. Vanna tells you how much conviction you should have in a trade. If you get a long signal from our blueprint and the Vanna's gas meter is green, well, that's not just a grade A setup anymore, that's a grade A+. That move has fuel in the tank. But what about the other side? Say you get a short signal, but the gas meter is bright green. That's a high-risk trade, my friend. It means you're trying to short a market that has this powerful volatility-driven buying pressure bubbling up underneath it. You'd want to be really, really careful with that one.
So by combining skew for fear, charm for time pressure, and Vanna for fuel, you're not just trading price anymore, you are literally reading the entire institutional playbook. So the only question left is, where are you going to find your next A+ setup?